Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
This is Buzz Lightyear to infinity and beyond, welcoming you to episode 1465. We've got part one of Mark Moss today as we go into some interesting discussions. And hey, hopefully you've been enjoying the week. We had Jim Rogers, the famous legendary Jim Rogers. And then yesterday we had the fantastic Consuelo Mack. But Paul reached out to me. Paul, you're a listener, and you said this: did not like this interview. Couldn't help but imagine Jason cringing when she was talking about the stock market and liquidity. The stock market is the biggest casino in the world. Yes, Paul, I agree with you. Here's the deal, folks. You got to understand this. And I'll do whatever you want. If you all go to jasonhartman.com/ask and you send me thousands of comments and you say, Jason, you got to re-educate these people. And we don't mind if you take 15 or 20 minutes of every episode to re-educate these stock market people. Jason is your man. Yours truly, I'm your man. I'll do it for you. But I think it's a waste of time. Look, most of the people in the financial world are stock market people. Consuelo Mack is a famous anchor, a reporter who has been covering Wall Street for a long, long time. I don't know exactly how long. Jim Rogers, he managed a hedge fund with George Soros, okay? I take it that Jim and Soros don't like each other, which is fine with me because I don't like George Soros. But, look, it's not worth me taking your valuable time to re-educate people and talk them out of the stock market that their whole career has been built on, okay? It's just not productive. So let's learn what we can from them, apply it to the most historically proven asset class in the world, income property. I mean, Consuelo Mack said some kind of funny things. She's like, Social Security and Treasury bills. I know. Listen, I could debate that with her. I'd be happy to, but come on, folks. It's not worth the time. We're not going to learn enough stuff if we do that. So let's, as Stephen Covey, one of my mentors, told me in the 90s, he said, the main thing is to keep the main thing the main thing. And the main thing is not talking my guests out of their careers. That is not the main thing. But if you want me to, if you go to jasonhartman.com/ask and you send me thousands of comments saying, Jason, that's what we want you to do, then I'll do it for you. No problemo. And I'm sure I will be successful. Speaking of stock market people, good old Warren Buffett, he should be listening to my podcast, but I'll bet you he's not, because I would have saved him $703 million had Warren been listening to me. Clearly, Warren Buffett does not follow commandment number 3. Yes, Warren, commandment number 3 is thou shalt maintain control. Because when you relinquish your control, you leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. Number 2, you might be investing with an idiot. And number 3, assuming they're honest and competent, they're going to take a huge fee off the top before you get your cut. And, well, number 1 is exactly what just happened to Warren Buffett. Even Warren Buffett. Check out this article. Okay, Warren Buffett allegedly swindled out of $703 million. A German manufacturing company has been ordered to pay it back. The question is, will they be able to pay it back? They probably won't. They'll just file bankruptcy. That's what happens in these cases. I mean, I've taken a couple people to task and they filed bankruptcy on me. And guess what? The court system may be great. You'll get your judgment, or, they'll just file bankruptcy in the middle of the case. And then, you have to ask yourself, is it worth pursuing it? Right? And that's the problem. That's the way the system works, folks. Anyway, even the chairman and CEO of Berkshire Hathaway is apparently not immune to losing millions due to fraud. A German manufacturing company, by the way, this is a newser article I'm reading. A German manufacturing company allegedly swindled Warren Buffett out of more than $703 million. That's almost $1 billion there, folks. The Guardian reports a unit of Berkshire Hathaway paid more than $875 million for the family-run company. Wilhelm Schultz in 2017. That's the name of the company. Person's name, so I thought it was a person they were talking about. Anyway, but a whistleblower tipped Buffett's company off to the fact that the company orders and invoices had allegedly been doctored in order to make the business look like it was worth more than it actually was. In truth, a court ruled last month it was in danger of going bankrupt and was worth $171 million at the most. Remember, they paid $875 million, and that math is not exact. What are they doing there? $875 million minus $171 million is not $703 million. Now, I don't have a calculator in front of me, but I think their math is slightly off. Hey, come on, it's only $1 million or two, something like that, right? It's $1 million, I think, right? It's only $1 million. No big deal. It's a rounding error. Anyway, it has been ordered to reimburse the difference. A state prosecutor in Germany is also now probing the stainless steel pipe maker, which insists it did not defraud anyone and is appealing the court's ruling. So, Warren Buffett, how much did that litigation cost you? I bet you got ripped off for a lot more than $703 million by the time you pay those darn lawyers. Those lawyers are expensive. So, anyway, hey, Warren Buffett, follow Jason Hartman's commandment number 3. Yep, that's what you need to do. Thou shalt maintain control. Maintain control. All right, what else, folks? I don't know. There's so much going on. There's just too darn much to cover. But one thing I want to say is let's talk about offices for just a moment. People have been saying that office space, if you're a commercial property investor, and you invested in office space, and even if you didn't, this matters to you. I'll tell you why it matters. Because the office is quickly becoming kind of old hat, okay? And we don't know if anybody's going to go back to an office in any major numbers, right? They've been working at home. They realize they can work at home. Hopefully they realize they can be productive at home, and so did their management. So office space as a property investment class is in trouble, right? Everybody would agree with that. But there is a cross current here, and that is that COVID-19 is changing the office space that is left over, right? Because some companies, they won't give up their office space. They still will feel they need an office. Not everybody's going to be remote. It's a major trend, but it's not everybody, right? So those who are left will be taking more office space with all these new social distancing rules. We talked about this before. And so it will actually expand the need for office space to some extent, right? Because they'll reduce the number of desks in those offices and increase the number of square footage per employee, right? So that's a countervailing trend. It's the opposite. Like, most people just be giving up their office, but the offices that are left over, they'll need more space. Now, the question is, will they negotiate with the landlord and say, hey, give us more space, but even though you're giving us more space, we're not even going to pay the rent we were paying before. And so now the landlord's in trouble. Trickle-up economics, according to Jason Hartman, says that the landlord will now go to their lender and say, hey, lender, sorry, we were paying you $30,000 a month on our mortgage for our office building, but now we're only going to pay you $20,000 because all my tenants have renegotiated their leases with me. Regardless of what the lease says, doesn't matter, because you can't hold people to it in this kind of environment, right? You have to renegotiate. And so then the lender says, okay, well, maybe we'll have to accept a reduced payment or give you a forbearance. And then what happens? All those mortgage-backed securities start to default. They pay lower rates. Those investors don't get the return they expected. Then they have less money to spend in the economy, and then the economy shrinks in size. So that happens. We all get that trickle-up economics as opposed to trickle-down economics, Reagan-era concept. And so it all changes. And what does that mean for the home? Now, it's not like the world population changed by very much. So there's still pretty much the same number of workers. And all those people now need a bigger house because they need a home office. They need a place to work at home. And what if they're married and then they need 2 places to work at home? So instead of 1 spare bedroom for an office, they need 2 spare bedrooms for 2 home offices so that they can hear themselves think and hear themselves talk on the phone. And then, not only that, they got the kids that are home, and they even got the college kids that have come back home, because if you've looked at the articles about this, these college towns are really suffering. That is changing. All the real estate in these college towns suffering because, hey, nobody's in college. They're not there. They're going to be virtually studying, right? They're already doing it. And all the businesses in those college towns are suffering. Can you imagine all the restaurants and bars in college towns? Wow. And every other kind of business, every other kind of support business, because, you got to have a diversified employment base. And so they are changing. We're here to guide you through it. And the center of the universe is the home. So if you're in any home-related business, you're doing well. So good for you. Okay, let's get to our guest today. This is going to be a 2-part interview because we talked for quite a while. So we're going to run part 2 tomorrow, but part 1 is today. Let's take a deep look at a bunch of economic issues with Mark Moss. If you need us, you know where we are, jasonhartman.com or 1-800-HARTMAN. Oh, don't let me forget, webinar. We got a webinar coming up, and it is on 1031 exchanges, and it is this weekend, our weekend webinar. And all you need to do is go to bit.ly/1031profit. That's all lowercase, bit.ly/1031profit, and join us for that webinar this weekend. By the way, a lot of you have asked me over the years about asset protection, asset defense. We have a good webinar on that coming up with an attorney who is new to our network, who has some great deals. I'm pretty impressed, and I like this guy. He seems like a very conscientious, conservative attorney. He's based in Texas, and he's going to have a great offer for you. So I'm pretty excited about this. So that's going to be coming up. Look for an announcement on that. And also, we have made the executive decision that we are going to do Meet the Masters this year, but it's going to be virtual because we just don't know if we're going to get a chance to do a physical Meet the Masters this year. So we got a big announcement coming up on Meet the Masters. We're going to share my pandemic investing strategy with you there. So that will not be a separate webinar. The first time I think we'll present it for you is at our virtual Meet the Masters. So look for more announcements on that. We're very excited about it. And you know what? I've been attending a lot of virtual events and meetings and conferences. And I got to tell you, I like them. I'm getting a lot out of this. It's very productive. And it's from the comfort of home sweet home. So I think you're going to like what we're going to do. I've been learning from some other people. I've been watching them do it. I didn't want to be the first, And so I've learned a lot. And I think we're going to put on a really good Meet the Masters for you. What's this year? I think it's our 22nd anniversary Meet the Masters of Income Property Conference. And it's going to be virtual for the first time. So look for more on that. Coming up, webinar this weekend, 1031, starts on Friday is the first day, and then again over the weekend. And let's get to Mark Moss, part 1. Hey, it's my pleasure to welcome Mark Moss. He is a strategic financial analyst. He's a full-time investor. He has a fantastic YouTube channel. I've learned a lot from him over the time I've been following his work, and I am really happy to bring him to you today. He was one of the early people in the cryptocurrency space, so maybe we'll talk about that a little bit and some other things, namely what to expect next. Mark, welcome. How you doing, buddy?
I'm doing great. Always a pleasure to talk to you. Looking forward to it.
It's good to have you on. So everybody wants to know, what's next, right? And you really focus on a lot of strategy. In fact, one of your handles is Strategic Mark. I love it. And asset allocation and things like that. I mean, maybe let's start off by talking about what do you think the best strategy is for people nowadays and with all that's going on in the world?
Well, I think the best strategy for people is to recognize that nobody knows.
Yep. Good answer.
The smartest people in the world know that they don't know.
Right.
And so I think it's Porter Stansberry that says it's the things, or no, it wasn't him. Maybe it was like Mark Twain. Anyway, I have so many quotes in my head, but he said, it's the things that you know absolutely 100% for certain are the things that get you in trouble.
Mm-hmm.
And so we always have to kind of like have strong conviction, but also be quick to pivot. So the smartest people know that they don't know. And so what that means is the best strategy is something that kind of spreads out your risk, gives you better upside by participating in some of these things, but also limits the amount of risk that you're giving yourself. So for example, I'm sure we'll get into Bitcoin. Bitcoin, I believe, is probably the most explosive asset. It's been the best performing asset for the last 11 years. I believe it's the best risk adjusted asset that we have today. And so many people are like, oh, it's way too risky. I would never buy it. And that's fine. And nobody should go 100% in. But like, one of the best investors in the world, Paul Tudor Jones, just said that he put 2% of his portfolio towards it. So it's about like, hey, this has a chance. And so let me put 1 or 2% towards it.
It's a small bet and it might be a big payoff. I get it. Right. Yeah. Versus, people that put, 20% plus, they're taking a big risk, right?
Right.
Yeah.
And so I think the biggest mistake that I see people make is always trying to guess what the right asset to invest into. No, don't buy Bitcoin, only buy gold. Right. No, don't buy Bitcoin. Don't buy gold. Only buy Bitcoin. Why? Why not buy both?
Mm-hmm.
Well, only in real estate. Well, why just real estate? Why not real estate and gold and Bitcoin? Right? Like, why do you have to choose only one? You don't have to. And so I think that would probably be the biggest mistake that people make. The other thing, if we're just talking like big overarching kind of thesis, is my biggest thesis, my investing thesis I pound the table on is always investing for cash flow. And you say, well, Mark, you were just talking about investing for Bitcoin. Bitcoin doesn't have cash flow. You're absolutely right. Part of my portfolio, of course, is for growth, but I take that growth, I take those profits from growth, and I always invest them back into cash flow. So cash flow is always the name of the game for me. I think the lie that we've been told for 40, 50 years of, go to school, get a good job, save for 40, 50 years and live off your savings is ridiculous. And we know it doesn't work because half the baby boomers today don't have any savings. So that doesn't work. So rather than live off savings, I think we live off cash flow, and it's much easier to obtain than people think.
Yeah, absolutely. I think that's very good. And I think that's what true investing is. It's investing for yield, for cash flow. Absolutely right on that. But I see your point about, taking, 2% of your net worth and putting it into a swing for the fences type of thing. You probably know Jason Calacanis, and, he talks about investing in startups and so forth. And, most of those are just total losers. You're going to lose your money. Just get ready. But you hit on one, and that one could have a multiple that's really extreme if it's Facebook, for example, right? And so Peter Thiel would probably concur with that kind of thing. So I agree. That's interesting. So let's talk about that allocation. Like, is there a specific percentage? I know we talked about, maybe like Tudor Jones, 2% in Bitcoin, but how do you allocate everything, like that whole pie?
I wish there was like a one size fits all. It's not. So everybody kind of has their own, what I like to call investor DNA. And so we have to figure out what's right for us. The one thing that I would say back to Paul Tudor Jones, and like you talked about the guy investing in these startup companies, most of them don't make it. one does. And so that's an important thing to pick out right there. So if you're going to invest in these risky type assets, like startup companies, for example, like a venture capitalist would, a venture capitalist is going to take their total amount they're allocating towards venture capital and then divide that between, 15 to 20 different positions. Because they know, just as you said, most are not going to make it, but a couple will hit. And so if you're just going to go for just one, your chance of success is very, very low. And so you really need to go with a plan. And so like Paul Tudor Jones or like these venture capitalists, I'm going to take 20% of my total portfolio and put it towards startups. And of that 20%, I'm going to divide that between 10 different positions in that venture capital allocation. And so that's the way that we do it. So overall, just from a super high level, we all need to find out what it is for us. And the reason why it's important to find out what it is for you is because it changes. My allocation is different today than it was a year ago. And it's way different than it was 10 years ago. And so we need to understand how that works. And so ultimately, I teach something that I call the 4-pillar blueprint. And basically what that is taking your total investable assets and breaking it down into 4 different categories, which is 1, investing for growth. And depending on how you feel, your risk tolerance, your time horizon, how much money you have, your sophistication level, et cetera, you might put anywhere from 20% up to 80% of your portfolio in growth. And then, of course, growth would be all these things like venture capital, Bitcoin, equity, stocks, et cetera. Another one of the pillars is investing for cash flow, which we just talked about. I think that should be a big piece of someone's portfolio. In the beginning, if you only have a little bit of money, maybe you're only putting 5 or 10% of your portfolio towards cash flow. But as you get more money, as your portfolio gets bigger, I try to put about 40 to 50% of my portfolio towards cash flow.
Right. So the old saying, in risk what you can afford to lose, right? Yep. So as you become more wealthy, the allocation switches where I don't know. It's sort of interesting, Mark, because some people, they say, well, when you've already kind of made it, you want to get really conservative and diversification preserves wealth, concentration grows wealth, right? But you can also afford to lose more. It's not going to affect your lifestyle necessarily if you're wealthy and you lose, whatever you consider to be a lot of money, right? Your lifestyle won't change because of it. You'll be depressed about it and bummed out, but it won't really matter, directly. So how do you reconcile that?
Well, because it all comes back down to your own personal circumstances and mentality. So for example, before we started recording, we were talking about how I grew up racing dirt bikes, and I have a TV show where we ride dirt bikes. I do it a lot. And just the other day I crashed and I'm hurt right now. And I'm a little bit banged up, cracked rib, separated shoulder. And so the reason why I bring that up is that my risk tolerance is obviously very high. Most people my age would be like, heck no, I ain't getting on a dirt bike. I could get hurt.
Yeah, right.
And I say, yes, of course you're going to get hurt. It's not a matter of if, it's a matter of when, right? So what I mean by that is that my risk tolerance is high. And so also that carries through into my investing. I'm not afraid to lose some money because I know it's inevitable. I know I'm going to lose money, and that's okay because I'm going to make it back. Whereas some people are not okay with that.
Right.
And so it really comes down to your own personal perspective, and you and I are not the same. Nobody's the same. And even like I said, and you mentioned age is one of those things where as I get older, I need to be less risky than I was when I was younger. So on a dirt bike, I'm less risky than I was when I was younger. My investing is less risky than I was, So it changes person to person. It changes over time, and each person needs to find their own tolerance.
Okay, makes sense. Good stuff. So in terms of what's coming next, I mean, just maybe the general economic question, inflation or deflation, like that's always the easy, well, it's not easy, but it's not easy. It's only 2 choices. There are some variations like stagflation in there. And by the way, that's what I think's coming. But, what do you think, Mark? I mean, we've got all of this money creation. It's insane. We've never seen this before, I was looking at an interesting chart this morning, by the way. I wish I had it handy. Maybe I'll find it during our talk. But it was the percentage of GDP for various countries for coronavirus, what they've dedicated to battling the pandemic and the economic devastation from it and so forth. And man, it's huge. I mean, these countries are spending a huge portion of their entire productivity, their GDP, on this pandemic. Is that going to be inflationary?
So technically, yes, right? So you have to understand kind of money creation. So money's created through debt. And so as they create more money, as they create more debt, it's like a balloon, it's inflating the balloon. And just like anything, the more money they create, the less the existing money is worth. And so I try to really boil this down to something super, super basic. And people want to get all complex. And I think these economic PhDs, they get so smart, they forget the basics. And the basic is supply and demand. Mm-hmm. Everything in life comes down to supply and demand.
Good
Scarcity.
Yeah.
Scarcity. Mm-hmm. That's it. So when there's more supply than there is demand, the prices drop. Nobody wants it. There's too much of it. Nobody wants it, right? But if there's more demand than supply, prices go up. And so when you think about it, when you have money inflation, it's inflating like a balloon. We're creating more money, supply, but the demand hasn't changed. And so it's just going to affect that. I guess to answer your question, what's going to happen? We're in this interesting really the whole world changed from 1971, which is when we got off the gold standard.
Right.
And so for 5,000 years, wealth, and this kind of leads us into Bitcoin a little bit, but it's about money, right? So for 5,000 years, money and wealth was related to gold. We had a standard unit of measure. Right. So everything in the world has a standard unit of measure. We both know what an inch is. We both know what a foot is, a mile is, a gallon is, a pound is, a whatever, right? I mean, I know what a degree is. Like we all have standard units of measure. Mm-hmm. And for 5,000 years, we had a standard unit of measure for money, for wealth, value. Yep. And today we don't. In 1971, that got severed. And what happened is that allowed us to create unlimited amount of debt. So since 1971, we've created like several $100 trillion of wealth out of debt out of nowhere. Right. And the reason why it's important to understand is since 1971, 1987, 2000, 2008, et cetera, the markets keep trying to contract, meaning that debt is deleveraging. So they've leveraged up the debt, they've inflated the bubble, and it keeps trying to contract down and deflate, right? Mm-hmm. And you're asking what comes first, inflation or deflation? But the problem is every time we see deflation, they reinflate it with more debt. But the problem is the debt gets bigger, and it gets harder and harder and harder to fill that balloon back up. And so you're asking the question, do we see inflation or deflation? Well, we already know that, in the U.S., they've committed, $6 trillion to reinflating this bubble, this balloon. And to compare that to 2008, it was $700 billion, which sounds like a lot of money, but it was $700 billion in 2008. Now we're at $6 trillion. So that's how much harder it gets. Yeah. And you already just said, like all these countries, you've seen how much GDP they're putting towards this. The problem is we have all this debt, and debt disappears in an instant. Mm-hmm. So when the airlines, or let's say like the oil industry right now, the oil industry is defaulting on hundreds of billions of dollars of debt. In an instant, it's gone. It's just gone. So that's deflation. Yeah. And the Fed's trying to fight that with reinflation. Right? Does that make sense?
Yeah. Yeah. And, one of the, we can all this is like a super simplistic idea, right? But we can all understand this, relate to it, and we've certainly seen it in our own lives. Debt makes people look richer than they really are. And it makes countries look richer than they really are. Yep. So since 1971, when Nixon took us off the gold standard, there was no tether anymore. There was no more measuring stick. And the U.S., the U.S. citizens, other countries around the world, because everything became fiat, and fiat just means by authority, right? Money has value because the government says so, right? Right. And there's been this wealth effect, but a lot of it is just smoke and mirrors. It wasn't really there ever. Right. The way wealth is created is through capital formation and productivity, right? Those are the real things that actually create real wealth. Yep. But you can create fake wealth by financializing the economy and, a lot of financial instruments, financial innovation. Whenever I hear a Wall Street guy say that, I'm like, a run for the hills, yeah. But temporarily it will make you seem rich. Right. It just doesn't last forever. Yeah.
And that's exactly where we're at. So you're 100% right that money or wealth is created through producing goods and services. And when I produce a good and service, I get compensated with wealth. And so you're right. What we've done over the last, especially 50 years, is we've outsourced all the production. Mm-hmm. And instead we've become a financialized economy.
Yeah. And now you're speaking of the U.S. outsourcing to Japan or to China mostly, sure. But formerly Japan. That's what you're talking about, right? And then financializing its own economy.
Right. And so just, I was just kind of adding on to what you were saying, right? So we financialized the economy. So we've created hundreds of trillions of dollars of debt, which is basically fake wealth, as you're calling it, right? Where it's like this illusion of wealth. In addition, I mean, there's like over $2 quadrillion of derivatives, whatever that means.
Yeah.
Of derivatives, those are bets on the financial system. And just to break it down super simple, they're bets. Again, it's gambling on the financial system. So, and it makes everybody seem richer. But the problem is, like I said, that debt can go away in the blink of an eye. With real estate, for example, is a real tangible asset. That's wealth. It's land, it's building, et cetera. And maybe that house could lose 50% of its value.
Yeah.
But like, it doesn't disappear.
Right.
The land is there. The house is there. But with debt, it's just gone. When it's gone, it's gone. Yeah.
Yeah. Good stuff. Okay. I found that chart I was talking about just to give you and the listeners and viewers a point of reference. I just thought I'd share this with you. So Japan has spent the most in terms of coronavirus stimulus packages, 21% of its GDP. US is number 2, 13%, Sweden 12%, Germany 10%, and on down from there. But Japan, 21%, and Japan of any developed country has more debt than anybody. Their debt to GDP ratio is like 230% or some insane number like that. It's crazy.
What's on the low end?
Well, on this chart, it doesn't do every country, but it does like the top, 10 maybe? South Korea, 2.2%.
Yeah.
So not bad.
And they've done really well with it.
Yeah. And a lot of people have really applauded South Korea's response to coronavirus, saying they did a really good job with it. So, yeah.
Yeah. And only took 2%. Amazing.
Yep. Yeah.
That's a whole other subject for another conversation. But ultimately, I guess it does tie in a little bit in a sense where, as you're saying, which is absolutely right, which is all this financialized economy, this debt, it gives the illusion of wealth. What it also does is, because it wasn't money that you had to earn, you treat it differently.
Right.
And you're spending other people's money. So if I worked my butt off, like I got kids, right? I'm trying to get the kids to like, hey, work a little bit because you'll value it more, right? When you work hard for that money, you treat it different. But when you're spending someone else's debt, that money creation that came out of thin air, you're much more likely to just squander it.
Yeah. Yeah, no, that's a very good point. Very good point. When you got to earn it yourself, you're going to treat it better. And like the old saying, money always goes where it's treated best.
I love that saying. I love that saying.
Yeah, and we'll see if that happens between this huge war between California and Tesla right now.
That's interesting. So I live in California, and it's super interesting. And one of the most there's a lot of facets we could talk about, but the one most interesting facet that I found was back to your point, money goes where it's treated best, right? So Elon Musk thinks that Tesla isn't being treated right and it should move. Well, I live in California, like I said, so we've lost all the car manufacturers. They've already been gone. They're the last one left. If they leave, California stands to lose billions and billions of dollars. But Tesla could make billions of dollars from working in a cheaper state. What's interesting, though, is he says, I should move. And one of the representatives, I forget what her name is, she basically tweeted F Trump or F Tesla.
Right. Yeah. F Elon Musk. And that was like Loretta Gonzalez or something like that.
I think she's an assemblywoman for the great state of California. But look at the contrast is what I want to bring out. Yeah. So she says, F you. And Nevada and Texas say if you come here, we will roll out the red carpet. We will get you tax incentives. We will get you employees. So, I mean, are you going to stay in a place that says F you, or are you going to go to a place that rolls out the red carpet? And so just look at that, right? Like, it's just amazing.
Yeah, it's really, California is my home state too. I lived there the vast majority of my life, and I've never seen a state try so hard to commit suicide. It's absolutely amazing. It's like they want to ruin their economy. It's just weird. But there's a lot of wealth there. There's a lot of people that came there many years ago and just won't leave that easily. It's sticky, right? It's not that easy to move. It's a hard decision. It's hard to do, So it's really interesting. Hey, talk to us a little bit about cryptocurrencies, if you will. This will be continued on the next episode. Thank you for listening and happy investing. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.